how to trade the market when the VIX is above 25. So the easiest way I can demonstrate how one can trade the market when the VIX is above 25 is to actually show you what you should be looking for when you're trading with Price Action Harvester Automated and using the special operations feature to take advantage of the volatility that the market is experiencing. So let's assume the VIX is above 25. Okay, and speaking of the VIX, there is a lot of misconception when it comes to VIX. The VIX is an index. Okay, you cannot apply technical analysis to the VIX. All right, it is an index. So if you get, for example, a triple top or a double top, whatever pattern that you see typically on that you apply, let's say, to the SPOOS chart, the NQs, or if you apply that to various equities, that would make sense. But you cannot do technical analysis on the VIX. Okay, that's just silly. I've seen, for example, a lot of people, especially on the retail side, and granted some CMTs that should know better, that basically are putting, for example, a triple top on the VIX, and they'll say, oh, the VIX is coming down. Well, you can have a quintuple top on the VIX and it still goes higher, but odds are what the VIX is doing when it comes back down is there is actual probability. There is historical data that we can use and reference to figure out that the VIX has a good likelihood, a bad likelihood of coming back down again. Usually over 25, over the next few days, the VIX does in fact come down. Doesn't matter if you had no top, it's just or you just had a double top or whatever silly pattern. It doesn't matter because it's not applicable to the VIX. If you want to know how the VIX is calculated, there's plenty of resources you can find on the internet. If there are any comments, if anybody wants me to do a video on that, I'd be happy to do a video on that as well, as to how to calculate the VIX and how its implied volatility is part of the S&P 500 options. So it's not like something that you can go long or short on the VIX index, right? So it's not tradable like that, and therefore you can't do any legitimate technical analysis on it. Okay. When it comes to Price Action Harvester Automated, I built special operations to take advantage of such situations. You see, the mindset is, the viewpoint is, that a majority of the time the market is moving in a method that we can historically look back on and say, yes, we expected this kind of move. It does that about 80 to 85% of the time. So the main strategy that I have for Price Action Harvester Automated, which is composed of two strategies, but the main strategy is that, I should note, two separate strategies. The main strategy is that it's reliant partially on historical price action. Statistics really makes a difference, guys. Okay, it really makes a difference. I don't have to, go very far to explain this, but just think about this. Okay, let's look at it from another industry. So if you were to get a loan, right, the first thing that they're going to check is your credit history. Okay, they're going to want to know that your credit is good enough for them to give you that loan, right? Obviously, they check other things too. They're going to check to see your employment. They're going to check other things, but part of it is that they're going to check your credit history, okay? Because that's pretty telling. It's not always accurate. You could have had fantastic background history. You could have an 850 credit score, and all of a sudden, God forbid, something goes very wrong, health issues, personal issues, etc., and now you can't work, therefore you can't pay your bills, and all of a sudden things have gone very wrong. So things do happen, okay? But when you compare that to how the market works, historical price action, that's your credit history. Current price action, that's what's happening right now. What are you doing right now with your employment, okay? What's happening right now in the chart? So Price Action Harvester Automated, as I just mentioned, is composed of two strategies, and they run exclusive to one another. So they're not connected in any way. The main strategy is based on historical price action as well as current price action. But I also added in version 4, which was released in February of this year, 2022, special operations. So traders that are using my system can take advantage of the volatility, that this market is likely to experience for a while. Okay, this is of course my view. But it's going to, I think, happen all the way at least until 2024, where we have the presidential elections, and potentially after that, depending on who wins. Okay, so that I'm expecting a lot of. So typically, we get about 80 to 85% of what I call calm waters or expected waters, and then we get about 15 to 20% of the time volatility, that strong volatility that we can take advantage of. Remember, if things are too calm, there's not much happening. So I remember during Obama's time, there were days where we'd get 8 tick movements the whole day. You know, it wasn't always, but there were such days where you would get the whole day, the range was 8 ticks. That's why you have a lot of people during those times, they moved from, especially on the retail side, they moved from ES to SPOOs to trading crude oil because there was more volatility in crude oil than there was in the SPOOs. And so that's something that a lot of people have now seen in NQ, right? So they're seeing in the NASDAQ 100 futures, they're seeing a lot of volatility and they're jumping in, okay? So remember, as traders, we want volatility. That's something that we really want, okay? So how do you determine when to use special operations and how to use special operations? So the first thing you're going to want to do is, because remember, special operations is an event-driven thing. So it's based on some premise that you have that's happening via an event or news-based. Essentially, it's a macro thing, some geopolitical thing that's giving you an opportunity potentially to take advantage of what the market is, what the market can give you. And so what you want to look at is what's the news of the day. So the news has been, as of late, obviously we have the war, but the crude oil, the price of oil, and the price of gold is essentially big right now. And so we're hitting all-time highs on these instruments. And so when you get this kind of a move and everybody's talking about it, that becomes the news. So the higher the price of crude oil, the lower in this environment one can expect the market to go. Okay? So if the price of crude oil is increasing, you can expect, not always, but you can expect most of the time, to give you some statistical edge, that the price of the SPOOs or NQs is likely to go down. Okay? Conversely, if there was a huge day the day before on crude oil and price was going higher, but today crude oil starts to go down again, well, now you can go the other way. You can say, well, the inverse relationship there is that the SPOOs or the NQs are going to go higher today. Okay? No guarantees, obviously, but this is an assumption that one can make. So, well, let's say you wake up in the morning, and I'm in Los Angeles, so I'm in Pacific Standard Time, and let's do some very basic, very, very basic price action analysis. I'm not going to put anything on this chart. This is a bare chart, okay? I'm not going to put any technical indicators here because we don't need it. So the only thing that we're going to look at is price. That's it. All right, so let's say you wake up in the morning, it is approximately 6 o'clock, and you look at what crude oil is doing. But you want to wait until that initial balance, okay? What happens in the initial balance? You have the most volatility, and a lot of the time, but not always, it sets sort of the trend for the day, okay? So you can basically look at what's happening in that initial hour, all right? So some people divide that into 30-minute increments. They say the initial balance is two 30-minute increments. Others say it's just the initial 30 minutes. I look at the whole hour, but you get a lot that you can basically take out from that analysis, just that in that 30 minutes. It's the first 30 minutes. And so I'll just look at the price, and I see crude oil right around 6 o'clock. So you saw here before anything happened, this little breakout. So retail, for the most part, was trading at these hours. This is before the regular trading hours. They tried to get a breakout here, and let's see what happened. It looks like it's coming down, right? It's coming down right here. If this level gets taken out, you've got a potential signal there, and it did right there, 640. Okay, let's see if we can get some more confirmation from the market. This is gold. Okay. So let's go back and see what happened. So gold just broke down right off the bat. So let's see what happens. However, that first, if this level gets taken out, we have further confirmation. Okay, that 1997 level. And that didn't happen with gold until right there. until right around this time. Right around that time, 7:10. I don't need to see anymore. I get this green bar. That's fine. This level got taken out. Okay, the close versus the close. It got taken out. So now I can make a determination on the SPOOs. Okay, this is when we say market, generally S&P 500 is what we're referring to, and this is the underlying is the S&P 500 for the SPOOs. Okay, so the E-mini S&P 500 futures, to be specific. So I've now made a determination, right? Now I have a long bias. I've made that determination. I have a long bias. So all I'm going to do is the following. I'm going to load the strategy, price action harvester automated. Okay. This is the portion I was referencing. Well, today's Thursday. So today's Thursday, March 10th. Let's go and choose Thursday. This portion right here, day, time, direction, all the way from trade start time 1 through 5 is the historical price action plus current price action strategy. The ordinary typical strategy, which I deem to be a moderate strategy as far as aggressiveness goes. Okay, it is a moderate strategy. It is actually trying to stay away from the extremes. All right, so that's that part. I'm not going to use that because I've seen that the VIX is above 25. Okay, that's my first signal. VIX is above 25. Signal for what? To use special operations. Okay, the VIX is above 25. We still have volatility in the marketplace. Okay, then I want to see what the news was yesterday. The news was about crude oil. Obviously, the overarching news, the macro news, is we have a war raging between Russia and Ukraine, and it could potentially involve other countries, which means it could be a NATO affair, which means World War III. And so that is on in the backdrop. We have this issue. We have inflation as a further backdrop as to an issue, but that's not how we make a determination when we're day trading, right? We're not looking at the macro side. We're not going to hold this for the next few weeks or few months. We're in today and we're out today. Okay, this is a day trade. So we're trying to see how we can take advantage of what's going on right now. Okay, and so we basically we've decided we're going to use special operations because why? The VIX is over 25, and there are events that are leading up to this decision of using special operations. Meaning, oil was up yesterday, huge, but it's now selling off. Gold was up big, and now it's selling off. That's all we needed to see. Price broke down during that initial hour. Okay. And that happened with crude oil. That happened with gold. And it doesn't have to be exactly 30 minutes. Okay, guys, this is not that kind of a science. Okay, it's just right around. Okay, is good enough when you're making this decision. It doesn't work like that in trading. Okay, it's science plus art. So you have to make a decision as to right now. All we're doing is directional. We're picking a direction. Now, I'll also show you in this video if you didn't know which direction to pick, but you knew you had to use special operations because you saw there was volatility in the marketplace. How did you see that? Empirically, you looked at the VIX index, and once you looked there, you saw it was over 25, and that is good enough for you to make a determination that it's special operations time. Okay, let's load special operations. So I just unchecked the typical strategy, which is this top part. You can leave this the same. You can zero it out if you want to, or just leave the time the same. It's not going to go on because I've unchecked go long and go short. Okay, let's look at money management. All right, when it comes to special operations, in essence, you know that there's going to be volatility in the marketplace. So you're going to have to come up with some money here. Again, trading is something that people should do when they have excess capital. You say, well, I'm going to take risk today because I'm looking for hopefully a big return, but I'm willing to take a risk for that. Because remember, another thing that's a fact in trading, okay? The higher the risk, the higher the reward. The lower the risk, the lower the reward. Fact. Higher the risk, higher the reward. Lower the risk, lower the reward. Fact. Remember that. So I have to take more risk if I'm seeing that there's more volatility in the marketplace. I have to take more risk, okay? But I'm also hoping for more of a reward, okay? We'll see what the market gives me. So I'm going to say that when my trading is flat, when the system is flat, if I'm down 1100 or more, I want the system to stop trading. Moreover, I'm going to say, notice I always start with the losses first, okay? Because that's what you have to be careful about. Next, I'm going to say net session profit limit. If I make $5,000 when the system is flat, if I'm up, not make, but if I'm up at least $5,000, then I want the system to stop looking for trades. Moreover, I'm going to say if I've had, this is a decision I can make, 2 consecutive losses, then I'm going to stop trading. You could have said 1, you could say 3. Okay? It's up to you. I'm going to choose 2. But usually it's not much bigger number than that unless you set up the trade differently, and I'll show you. Okay, so next what I'm going to do is say I want to also include move stop, okay, and I'll explain what that is. And I'm not going to say from the starting bar at 0. I'm going to say starting bar should be 0, not 45. And if profitable by 42 ticks. And I'll tell you where I got that 42. I'm going to show it to you, okay? I'm not going to worry about adverse price, okay? But let me quickly go back and explain what this is. Move stop essentially is going to move the stop from whatever the stop was to if it's in a long position to the current bid, if it's in a short position to the current ask price. Okay, that's what it's going to do automatically for you. And it's going to do that right at 0 bars. Okay, so meaning from the time you enter the trade, the very next bar, that's considered as soon as that bar closes, if I'm up at least, if profitable by at least 42 ticks, then I'm going to attempt to exit my position. I'm going to attempt to book my profit. And I'll explain why I got 42 from, and you could have chosen another number if you didn't have the tool that I'm about to share with you later. So I'm going to also put a profit target, a lofty one, of 399. Big profit target. I'll explain why I put that there. And then my risk, I'm going to do a couple of examples for you. So the risk that I'm going to take, remember I said you're going to have to take risk. Okay, this is a risky market now. The VIX is high. The volatility is high. If you put too small of a risk, your stop is too little, you're going to be stopped out like that. Okay, so you're going to have to take risk. Now, this means that you've essentially taken a risk of $12.50 because it's by ticks, 100 ticks times $12.50. So if you take that loss, you're down $1,250. Okay, one loss, you're down $1,250 if that 100 ticks hits. Okay, that stop hits. Next, I'm going to always, this is my view, always keep the recent integrity long and short checked. I'll explain that to anybody who wants to know what that is. Just let me know. And then I'm going to trade one contract, 1 unit. All right, here's special operations. Special operations, trade start time. I want to start looking for trades from 7:31 until 11:29. Okay, why this time? Because I'm waiting essentially for the initial hour to go by. Okay, then I'm trying to get out before there is any particular counter move that happens usually in the marketplace. Meaning, if there was a strong move up towards the close of the day, you might see the counter trend take effect. Its price starts moving down. Conversely, if there was a strong move down initially, then towards the close of the day, as you get near that final hour and the last 90 minutes of trading, then there's a counter trend that typically develops, not always, where price starts moving up because it was initially down. Okay? So I want to not worry about that. So I'm going to simply avoid it. I'm just going to trade from potentially trade from 7:31 till 11:29. Why did I say potentially? Because I am looking for trades. The system will be looking for trades during those times. It may not get the right setup, so it won't take it. But this special operations is incredibly aggressive. So odds are it's going to find some trade. Okay? So I decided that I'm going to go long, right? So I'm going to choose long. Go long, event driven. I am going to exit at 12:59. Again, this is Pacific Standard Time. So that's 1 minute before RTH close, before cash close. And we also want slippage in this. Okay, so give us 1 tick slippage so that we have some slippage in there. Okay. Now, why did I choose these settings? Okay, so I have a tool that I developed. Okay, let me go ahead and set this, enable it, click on apply. Okay. And I'm going to, once I click OK, the strategy is now simulated, obviously, because it's 7 o'clock Pacific Standard Time. And the market is obviously, that I just showed you was from earlier this morning, okay, Thursday. So it's going to be from 7:30 until 11:29 that it's looking for trades. So it's simulated. It's hypothetical. And so I'm going to show you something else now. This is Market Analyzer in NinjaTrader 8. So in Market Analyzer, I have an indicator that's also called Price Action Harvester that essentially breaks things down statistically for me. Okay, and I'm going to show you how this works. So this helps me a lot, but you don't need it. Do I recommend it to anybody who is serious about trading? Absolutely. If you're an occasional trader, you may or may not need it. But if you are trading aggressively, you're an active trader, it's, in my view, like a very easy decision to buy this. Okay, so I've loaded Monday, Tuesday, Wednesday, Thursday, Friday. I can show you. Okay, and how did I load it? So basically, I choose my templates. Anybody who gets Price Action Harvester, the indicator, as opposed to Price Action Harvester Automated, which is the strategy, would also get these templates as well. So I've loaded the relevant templates, and essentially, let me show you the columns. Essentially, they are for the last 5 Thursdays. For Wednesday's case, it was the last 5 Wednesdays. For Tuesday's case, it was the last 5 Tuesdays. You get the point. And it's looking for the initial balance between 6:30 and 7:30, the initial hour. Okay? It's trying to give me statistics, not trying. It is going to give me statistics based on the initial balance of the last 5 Thursdays. And what do we get? We get that 60% of the time, price moved higher in that initial balance. 40% of the time, it moved lower. We get some other cool data that we can use. Okay? Notice this minimum up, 42 ticks. That's the minimum up. Maximum up was 181 ticks. Okay? Minimum down was 112 ticks during that initial balance. Maximum down was 146 ticks. So that 42 you saw me enter in special operations, okay, which is here. It's going to be grayed out, guys, but in fact, let me just make sure it's not grayed out so I can show it to you. Let's go disable this, apply. So you saw me put 42 here. Right there for move stop, okay? 42. That's where I got my 42. Okay? It's based on recent historical price action of the initial balance, which is the most volatile period of the trading day of the last 5 Thursdays. We can't just do yesterday. Yesterday's not enough. It simply isn't, because we want to make sure that everything is lining up the way that it should. Okay? You always have to look back when you're studying data as to that particular day. It doesn't take much research to discover that Monday doesn't trade the same way as Wednesday does. All you have to do is trade for a while. You'll very easily see that. Okay? Same is true with Thursday. Thursday doesn't trade the same way as Monday does, or how Friday does. They're different. If you've been trading for a while, you've already seen that in the marketplace. You see that price moves differently on those days. Okay? So it's very important to recognize the day. Most tools that are developed out there do not consider this. Now, I used to call on hedge funds all the time when I first started this. I'm going to show you guys, I'm an old school guy, so I used to literally print out the data of the various funds. Okay? So I used to subscribe to a database, and that database would give me all of the information that I needed as far as how hedge funds work, what their returns are, because I used to only call on the ones that were doing poorly. And so they had an automated system, but they were doing poorly. Okay, so I would call on them. And my list was, as you can see, pretty long. I divided it into 2 separate types of calls that I used to make, different clips. But anyway, so in this fund, I'm not going to give you guys the name, but I'll tell you a little bit about the fund. Okay, so this fund is in Illinois. Let me tell you about their strategy. So their strategies managed futures. Their AUM was between $100 million to $200 million. Currency was USD. Even though they're in Illinois, they're domiciled in the Cayman Islands. You understand why. And their inception date was June of 2010. High watermark, yes. Minimum investment was 100 grand. Management fee 1.5%. Performance fee was 20%. When I was managing money, my management fee was 0%. My performance fee was 35%. Okay. Subscription is 10 days. Redemption is 10 days. Lockup is none. So that's good. You always want lockup. I also had no lockup, and I also had a high watermark, just like these guys. And my minimum investment was also 100 grand. So let me read their description. Okay, I'm going to hide their name because I don't want to give free promotion for them here. But let me read you their description so you get an idea of how hedge funds and other funds, not just this particular fund, but other funds that are using quantitative analysis in their strategy, how they think about things. So this is the description they provide the public as to, or other investors, I should say, as to how their strategy works. Obviously, nobody's going to tell you precisely how their strategy works. Okay, at least nobody that I know that's worth their salt will tell you exactly how their strategy works. Okay, because there's value in that, obviously. And so let me read it for you. The strategy encompasses highly liquid futures only, providing transparency and scalability through a small team of individuals. The combination of macro fundamental approach combined with trend following and price statistics to trigger trades expressed entirely through a systematic fund gives a robust return profile that differs from the majority of CTAs. Okay, so this is just one example. There are many others in this bunch here, okay, of people that are running hedge funds. You saw it, between $100 and $200 million fund. That's considered a small fund, by the way. But you see how they're doing it. It's based off statistics, okay, partially. You can't just completely base it on statistics. That would be ridiculous, okay? You still need to have current price action. So, but they are using price statistics. Obviously, the price statistics right now would be meaningless. So if they were looking at price statistics this very minute, it would have zero meaning to it. In order for price statistics to have any meaning, you have to look at a historical database, a historical data. And once you study the historical price action, now you can get price statistics out of that data, okay? Remember, the industry spends $32 billion. That's 2019 data. $32 billion on data. $32 billion on data. So it's not like a mistake. Okay, they're spending this money because they can do something with that data. Okay, they can use it to their benefit and to their clients' benefits. So I chose the minimum number that price had moved during that hour, okay, which is the most volatile time of the trading day. That's how I made this decision. I could have chosen a different number. I didn't have to use 42, but I chose the minimum. That's how I view things. I think it's best to use actual data. Okay, you don't have to, and I'll give you an example of somebody who would not have this tool. What would happen if they use their own way of doing it, just guessing at a number? Okay, and so the other part that I put in is I put a profit target of 399. Okay, you're gonna say, well, that's pretty lofty. Why did I do that? Well, again, it was based on, so my profit target under price target and risk, my profit target is 399. Okay, why did I choose 399? Well, let's cancel this. Let's go back to the actual data from Market Analyzer. Okay, that is going off of my add-on indicator, which I've added. Okay, so you'll see here under 3SD, that's 3 standard deviations, is 398.54. This is in ticks. Okay, so I took the extreme. Okay, 399. That's what I put in. Now I'm not too worried about it. I have several other exits, right? I have the stop, which I don't want to hit, but that's one exit. And also have, as far as booking my profit, I have move stop, I have my price target, and then I have the exit where the time, it's a time exit at 12:59. So I have 3 other potential exits that are on the good side. On the bad side, I have the stop. That's the 4th exit. Okay, I don't want that to go off, but it very well could. And I do have 100 ticks there. Let's go ahead and load this up. So I have my price target at 399, my profit target. I'm going to be out of the trade if I'm up 42 ticks, guys, when that bar closes. At least 42 ticks. So when that bar closes, I could be up already 180 ticks because it was a big, gigantic bar, let's say. But it's at least 42 ticks, so it'll attempt to close it. And it 99.99% of the time it will. And if it doesn't, your stop is going to move so close to price action that it's going to be taken out. And if it doesn't, that's good for you. Okay, it's actually still in your favor. Risk, I explained if anybody wants to know what that is. I don't want to bore you guys with that, but it's a really nice feature. So we're looking for trades after that initial balance and in about 90 minutes before the RTH close. So we're looking for a long direction. Let's go ahead and make sure there's slippage, and we're going to enable this. Okay, apply, okay. Let's see what happened, guys. Let's see what happened. All right, so in the morning, it was looking for trades between 7:31. It's looking for trades. There's no signal here, okay? The system isn't finding the setup it's looking for. But at around 8, not around, but exactly at 8:55, it found a setup that it wants to take. And remember I said move stop was enabled? Well, my stop at 100 ticks was somewhere, let's see, 42.11, so way down here, okay? What happened is the stop got moved up to the current bid price, and it exited at 4.223, right there, booked the profit. The next trade, still, the signal is still there. Look at that. Price moved against me right off the bat, but my stop was 100 ticks. So this is about 42, 43 ticks, or I should say about 12 handles, right? Yeah, this is 12 handles. So 48 ticks or so. My stop is at 100 ticks, so down here somewhere. But price recovered. Okay, let's just move it this way. And it booked it again, move stop. So the stop was somewhere down there. Somewhere down there. It doesn't really matter. So the stop was just down there, you guys understand. And then it moved the stop from down there to here, and it booked the profit. We still have a signal. Okay, our money management numbers have not been met. Remember, we said 5,000. If we were up, if we had, let's say, 500 there as opposed to 5,000, it would have stopped looking for trades because you're already up more than $500 here with these two trades. Okay, but we put 5,000 because we said, okay, we'll risk $1,250, but I want something for that risk. I'm saying, let's hope the market gives me 5,000. I may not get there, but let's hope it does. Okay, let's see what it does. Now, of course, I can almost hear somebody saying, hope is not a strategy, Rafi. You're right, it's not. But that's what we're hoping for, that we hit that number. So the next one, it also entered here. The trend was still good. It entered that trade, booked it right there, moved the stop. That's another 12 handles approximately. About 48 ticks there. And that's it. Those are it. Those are the 3 trades that it took. So let's take a look and see what happened. It took 3 trades. They were all good because the stop was very lofty. It was 100 ticks. I took a lot of risk in the marketplace. So this worked out. It stopped looking for no further opportunities. And we also stopped looking for trades, actually, furthermore, at 11:29. So time here is 11:50. What would have happened if I had selected a different stop as opposed to 100 ticks? Let's say I wanted to take less risk in this market, okay? Because if you do the math, one stop loss at 100 ticks, you're down $1,250, and you'd be done for the day. So if that initial trade was wrong, you're done for the day. If somebody doesn't want to trade that way, there are other ways that they can trade. You can set up the trade differently, okay? Here's how you can set it up. You say to yourself, okay, well, I'm used to doing 30 ticks, okay? 30 ticks in the market as far as my stop goes. That's what I'm used to. So at 30 ticks, let's just make the numbers visible for everybody. At 30 ticks, you're in $375, okay? $375. So why did I have a calculator? Not for the 375, but because we're going to do some other math right now. So let's say if I lose 2 trades in a row, then I would be down $750. That's still less than my 1250, just to make it's $500 difference there. Okay, so now I'm taking less risk into the market, and I am going to nonetheless have to make sure that I am in the market for at least that amount. Okay, so if I put 1100, that's too much. So I just put in 600 just to be on the safe side. So after $600, I want to be done for today. So at 700, it would be more than 600, so it's going to stop looking for further trades. So I put in a number below that 700. I could have put 650, I put 600. Okay, it's going to stop looking for further trades when the system is flat. Okay, and if I have 2 consecutive losses, I can say 3 consecutive losses. Okay, why? Because remember, guys, this is a net number. So I could have had one trade where I was up, let's say, $1,000, and the very next trade I'm down $375 because my stop just went off. Okay, you have to subtract that. That's a net. Okay, you're still up net. So we haven't hit the net special loss limit yet. So let's say I want to take 3 trades, 3 consecutive losses, because what I have protecting me is this number right here, 600. Okay, so when the system is flat, it's going to stop looking for trades. Essentially, if I have 2 stops in a row that go off, worst case scenario, 2 stops in a row, I'm above that minimum there of 600, and it's going to stop looking for trades. But that's the max I was willing to take as far as in the marketplace goes. I'm not even going to change this. Okay, I'm just going to say I'm hoping for my 5,000. I probably won't get there. Okay, but that's what I'm hoping for today. All right, so let's not forget, this is the risk per trade. So from 100, we put 30. Okay? I'm going to leave everything else the same. So I'm going to let this run. Let's see what the market does. I still have slippage enabled. I'm going to show you this, and I'm going to show you something else too. All right. So right off the bat, let's go back to the beginning of today. So we started looking for trades at 729. Trend is down. It's not getting anything. All right. And this is obviously short-term trend, guys. It's not long-term. So that one worked. The very next one didn't work. Okay. Remember, our stop now is 30 ticks. Got taken out. Boom. So we're up about 11 handles here. We're down about 8 handles here. Okay. We're still up technically. The next trade is a win. Move stop is again enabled. Move stop is enabled. The final one's a win. So let's see what happened. 1912. It actually did technically a little bit better than before. Okay? So 1912. Let's leave that up. Let me go and show it to you guys again so we have a frame of reference here. So I'm going to remove this, and I'm going to show you what I did here. So I had 1100 here, and I had 2, and I had 100 here, and everything else is correct. Enable. Always be careful, guys, when you're going over parameters. Make sure those are correct. So let's take a look at the performance when I took more risk, 1875. Now, I had no losses. Let's go ahead and let me show you something else. Okay? What if I wanted to be very nimble here? Okay? What if I said, I want to book this profit if I have 4 ticks in profit and price moves against me? So now I'm in the trade, price moves against me. So if I'm in a long trade, price starts to come down. Okay? Price moves against me. I'm going to be incredibly nimble here. Okay? What happens? Let's change this back to 30, change this back to 600, change this back to 3. Okay? And let's see what happens. Make sure it's enabled. All right. Obviously, we're going to be entering a lot more trades, guys, because we're now looking to book a profit if we're up at least 4 ticks and price moves against us. Price moved against us right here, these 2 little red bars. Booked the profit, entered long, mistake, took the stop loss there. Entered long, booked the profit. Remember, we said 4 ticks. It's going to be nimble. Price moved against us. We're up by 4 ticks at least. It booked the profit. Again, booked the profit. Price moved against us. Price moved against us, book the profit. Price moved against us, book the profit. Let's see how it did. 1,200. Okay, you're still up. You had more trades. Okay, but you're up less. So this is how you have to think about risk and reward. You have to make this determination as to how you want to trade. Okay, you can set up your trade so that you have full control over how much risk you're willing to take in the marketplace. Okay, that way you sleep better at nights. And that way you've understood from the risk to reward relationship, you've analyzed that, and you've done what's right by you. Okay? And finally, for those that really can't make a decision as to which direction they should take, they see the opportunity that they can take with special operations. They see the VIX, the volatility, the VIX index is above 25. They see there's opportunity in the marketplace, and they want to be aggressive about it. That's why they want to use special operations, but they're not quite sure as to which direction they should pick. Okay? And for those people, in essence, let me give you an example. So let's go ahead and change the strategy. I'm going to leave everything the same initially, but I'm going to disable the strategy that was on, and I'm going to enable this time both go long event driven, that's already checked, but I'm also going to choose go short event driven. So now we're looking for both long and short trades for today's trading. Okay, so we're looking for long and short trades. I'm going to leave everything else the same. I'll give you guys a couple of examples here. The first one, I'm going to leave everything the same that we did on the last hypothetical back test here. So it's still going to be move stop at 4 ticks if the system is up by at least 4 ticks and price has moved against us, then move the stop. If it's in a long trade, it's going to move it to the current bid price. It's in a short trade, it's going to move it to the current ask price. Okay? 30 tick stop. This strategy, this system will give you the ability to have full control, in essence, of how you want to control and manage your money. Okay? Full control. And we're going to do that by, first we've identified the stop. It's 30 ticks. Since we're trading the spoos, $12.50, that's $375. Okay? And we've also said that if the system, when it's flat, is down $600 or more, stop looking for further trades. If the system is down 3 in a row, meaning not down, but loses 3 in a row, 3 consecutive losses, stop looking for trades, no matter what happens. So either net session loss limit is met or max consecutive losing trades is met, then it's going to stop looking. And of course, on the positive side, if the system, I should say, is hit $5,000 net when the system is flat, it's up by $5,000, then it's going to stop looking for trades. So this becomes very important. The time's still unchanged between 7:31 and 11:29. So slippage is still there, 1. And let's go and enable this. Okay. Now you're going to get a lot more trades when you choose both sides, long and short. You're going to get more trades in a given day. Okay, you're going to get a bunch of trades. So the system started looking for trades. When I say we, please understand, of course, as you know, it's the system. When the system is looking for trades, we programmed it in. I had put in 7:31 to 11:29. So the time is 7:34 here. And we've got a signal here. It entered the trade. The initial trade is a small win. You'll notice price moved against us, so we had adverse price. It checked the adverse price. Price has moved against us. Booked the profit. Did so again here. Did so again here. So 3 wins in a row. This very next one, it takes the loss. Stop loss is triggered. The next one's a win. The next one, stop loss is triggered. That one's a small win. That's a win. That's a win. That's a win. And the system stopped looking for trades because look at the time. It's 11:44 upon exit. Okay. However, we had programmed it, or I had set it up between 7:31 to 11:29. 11:44 is, that is correct, right? 11:44. 11:44 is outside of that time frame, so it's going to stop looking for trades. So let's see what it did. because now we've gone both directions, long and short. When I say we, again, the system. So total net profit is $1,000. Long trades did well, 1,075. You had six trades, 5 wins, 1 loss. Short trades had 3 wins, 2 losses, but ultimately lost $75. Okay, total net profit $1,000. So that's less than when we had chosen just the long position. Okay, so just long trades. But let's make it, another change here. So let's change the move stop, and let's say that you wanted to use the more aggressive 42 tick move stop, and we're not going to check for adverse price. The reason, remember, the 42 ticks is because of what I looked up on my price action harvester add-on indicator statistics. Okay, so let's go ahead and change this 4 to 42, and let's uncheck the check adverse price. So we're not going to check it. If we're up by 42 ticks, that's it. Okay, at the close of a bar. Remember, this is calculating at the close of the bar. So even though I have 399 ticks, doesn't mean that it's always going to hit 42. No, because you could, in a particular bar, in that 60 seconds, because this is the 1 minute that we're trading, you could have 90 ticks, 120 ticks, okay, by the time that bar closes. So upon the close of the bar, important, that's when the system will calculate everything. If the system is up at least 42 ticks, then it's going to attempt to book that profit. Okay, so let's go ahead and run it like this. Slippage is still there, 1 tick, apply. All right, let's see what happened here. All right, so the initial trade is a win. The second trade is a stop loss is triggered. The actual stop loss is triggered. The third one's a win. The fourth one's a loss. The fifth one's a loss. The sixth trade is a win. The seventh trade is a win. The eighth trade is a win. That's 8. And that's it. Look at the time. It's 11:50. So we're done trading because we stopped looking for potential trades until 11:29. And there it is, guys. Okay? You took the move stop, essentially was 42 ticks as opposed to 4 ticks plus check adverse price. 1,900. That's 900 more. In all of these hypothetical backtests, guys, I did not account for commissions. Not a big deal. Just take the, and the reason I say not a big deal, is because the amount is not big. And the reason I don't account for it right off the bat is because it depends on which broker you're using. Some brokerages like are, average $4, others, $7, yet others $10, depending on who you're trading with. Okay. So in this case, there were a total of 8 trades. You multiply that. Let's say your broker was charging $4, 8 times 4, $32. So you subtract the $32 from the 1,900. Okay, that's why I said it's not a big deal. But we have accounted for slippage. Now, at the onset of this video, I noted that one of the criteria that you may want to use when deciding if you're going to enable the aggressive special operations feature of Price Action Harvester Automated was if the VIX was over 25. So can you or should you consider enabling special operations if the VIX is below 25? The answer to that is, if you so choose, yes. Special operations is merely an aggressive, event-driven feature of Price Action Harvester Automated. So the VIX is really more correlated with the amount of risk that one should be taking in the market. Generally speaking, but not always, the higher the VIX, the higher your risk tolerance or one's risk tolerance should be. However, what if you had good news in the marketplace? What if CNN, headline news, Russians and Ukrainians, all hugs? It's all water under the bridge now. Okay? Or CNBC, inflation has dissipated. Fantastic news. Okay? Well, you might see price calmly move up. And therefore, the VIX doesn't move up, but it moves down. Because we have less of an implied volatility in the S&P 500 options and therefore the VIX starts going lower. You may still want to take advantage of the good news that's in the marketplace, and you may opt to be aggressive about your choice. And in doing so, Price Action Harvester Automated gives you the special operations feature, where if you decide to enable that based on this good news, you may want to do that. Okay? Completely up to you, because you've made a decision to be aggressive about this good news. Okay? Because you're anticipating that you got good news and you have now a bias that you should be in a long position, you should be in long trades, and you further want to be aggressive about it. Therefore, you choose to enable special operations if that's what you want to do. So there is no hard and fast rule when it comes to the VIX. It's just one more criteria, one more factor to look at. In any event, I hope this video has been helpful. If you have any questions, please feel free to email me at rafi@pinnaclequant.com, or you can leave comments below this video on YouTube. Until then, happy trading, happy diversifying, and God bless.